All right, so let's go ahead and finish up chapter 4 once again. So this is where we last left off, right? I just went over the accounting principles, right? So now we're going to talk about what a cash basis versus an accrual basis kind of business does, okay? So in accounting, we have two ways to record our transactions, whether we go through a cash basis or an accrual type of basis, okay? Well, in really straightforward terminology, right? Cash basis is when you recognize revenues when cash is received, and you only recognize expenses when payments or when cash is readily available for you to spend, right? So a great example would this be if you have a mom and pop shop that is strictly cash only. They will only accept your sales, or they will only accept payments, or in this case, they would only accept your service by providing cash, okay? So in this case, they will not serve to you if you don't have cash. It's a cash only type of business. And because they're running on strictly just cash only, that is the only way that they are also able to spend money as well, right? To buy all the materials that they need to be able to run the shop, is that they use everything strictly cash, okay? Where an accrual standpoint, okay, allows the business to owe people or have people owe them. So in this case, right, you are only going to recognize revenues when it has occurred, okay? So, or in this case, earned. When you actually earn your revenue, meaning the day that you sell your product or provide a service and it's been completed, is the day you're going to recognize your revenues, regardless whether you receive a payment or not. If you receive a payment, good for you. You had a cash sales. But if, let's say, a customer decides to say, I want to owe you on an account, you still record as if you earned that revenue. So again, many corporations, right, who follow the accrual type of basis, right, if you actually really run their reports based on a cash or an accrual type of basis, but an accrual basis, it looks like this company is doing so good. They earned so many sales. You know, it looks good to us in our eyes. But if we actually take it down and actually see how many of those sales were actually cash sales, right, you're going to see that they're not doing so good. Because again, a lot of corporations that allow their customers to either owe them on an account, right, poses problems because, again, their revenues may reflect that they sold something and that they look profitable, but in reality, they are not making enough money, like actual cash, because they're being owed the money, okay? And all the cash sales that they actually do record, right? Obviously, the company is also purchasing stuff as well, spending money left and right. They also have to have the assumption that they are obligations. They must pay what they owe, or in this case, they must pay for those expenses to happen. And if they don't have the cash flow, then that's why in most cases those kind of major corporations are not actually really doing really well because they allow people to owe them money. Okay? And again, expenses are recorded when occurred. Okay, so meaning the day that a service has been completed or the day that the product has been sold is when they actually record the expense, even if they paid or not. Okay, yes, yes, okay, Magdie's back, okay. All right. Any questions here between a cash and accrual type of basis?
No.
Okay, so one is strictly if cash comes in, then cash comes out. The other is you record it regardless of whether you received cash or not. Okay, so keywords here is you would record it when revenues are earned, and then of course you record expenses when it has incurred, meaning it has happened. Okay, so let's go ahead and take a look at an example. Okay, so an example here is that, let's say you are a construction worker, all right, and your task is to build an office building for $50,000, okay? And the construction is to start on January 1st and is scheduled to be completed by April 30th, okay? If the company pays you $50,000 on January 1st, okay, how would you record it? Okay, so you're a construction worker, you have a job that's completed, that is to be set to be completed, and you have the notion that this job starts in January and ends in April, okay? Now here's the criteria. The company paid you on January 1st. On a cash basis, you would 100% record the cash and say that the service will be provided, okay? And then, of course, on April, right, since you already received the cash, you are not actually supposed to be recording the service at all because you've already completed it. Or in this case, you've already received cash for it. Okay, that's on a cash basis, thinking that this is, okay, they gave me money, I'm going to record that I have earned my revenue right there because I received cash. Even though I didn't provide the service yet because it's January, right? It's not to be completed until April. So in this case, I'm going to record it because I received the cash as of January 1st. Okay? Where on an accrual basis, right? So in this case, right, we received an advanced payment. Now, the criteria is, did I complete my service? No, not yet. So in this case, under an accrual type basis, you're looking to not receive in this case, you are looking to receive the cash. However, you're going to create a liability instead of recognizing the revenue. So in this case, we have what's called unearned revenue, which means you owe service to somebody. However, I didn't actually record the revenue yet because this is a liability. All you're recognizing is you're just receiving the cash. However, in April, you are then going to say, yes, I completed the service in April because that's when the job was done. So that's the difference between a cash basis and an accrual basis, is that one, you receive the cash, so you're already assuming that the service has been completed, and when April rolls around, you don't need to record anything. On an accrual basis, you receive the cash, but you haven't recorded the revenue because the service has not been completed. It doesn't finish until April, which in here, April, I then record that I did my $50,000 worth of service. Okay, so that's a huge difference here, right? Now let's take a look at this example again, but this time, what if you got paid as of April 30th when the whole entire job was done, right? So again, on a cash basis, because you didn't receive cash until April, that means in January, no entries necessary because you didn't receive money in January. You received it on April. Okay, so here you recognize that you provided the service and you received cash as of April on a cash basis. Where on an accrual type basis, same thing's going to go as same as cash basis because the service wasn't done. You were told to do a job, but you weren't paid until April. So in this case, you don't need to record that you received cash or anything like that, or have an unearned revenue or any service provided in January, because April is when you fully recognize that a service has been completed and that you received cash for it. All right. So in this case, right, in this very specific scenario, the journals are alike for a cash and accrual basis because you're both being paid and the service was completed as of April 30th. Okay? Any questions here in how you properly journalize a business transaction using the cash or accrual basis.
No.
Okay.
So you're only using one or the other, is that right? You don't do both.
Correct. However, if you are a mom and pop shop or a sole proprietor, you do have the flexibility to start out with the cash basis and then maybe a couple years later go move into an accrual basis. Okay? Corporations 100% strictly is going to be accrual basis. Now, in this case, because we're learning in this class a small business, I'm going to show you to use the accrual basis because we will take an example of what it looks like when customers owe us money and when we owe vendors money. Okay? So again, this isn't a cash basis type of class just because I'm letting you know what your options are in terms of methods that you can use. If it benefits you to just be running on a cash basis, great. But again, accounting, this is where the GAAP rule comes into play, right? The two principles, which is revenue recognition and matching principle, allows you to run your business as an accrual type basis. Okay. Okay. Any other questions?
Yes.
Yes.
The entries before this, you write unearned service. Please return back to these entries, please.
Which one? The very first example, or this one right here?
Yes, the first one. The first service and unearned service.
So this one.
Yes, this one. You January, you mean in the accrual basis, you received the money, cash or check, 50,000, and earned service 50,000, and pay on January. When on April 30th, you canceled or the balance zero for unearned service. When I go to the trial balance or journal ledger, earned service, now the balance is zero, debit and credit 50-50.
Correct. It's zero because in this case, an unearned revenue is considered a liability because you're getting money to be paid in advance and that therefore you're obligated, right? Hence the word liability. You're obligated to provide the service because they gave you money to do a job that you weren't scheduled to do yet. The idea with an accrual basis is that the day that you complete the job is going to be the day that you record the revenue. Okay? The day that you complete yes. So in this case, an unearned revenue is a liability. So this where it tells me in January, I owe them that I have to build the building. But in April 30th, when I completed the whole entire building, I no longer owe them. In fact, I have to say that I no longer owe you, but in this case, I completed the revenue for you. I completed the service I owed you. So that's what this journal here is on April 30th. And yes, on the trial balance, as of April 30th, your unearned revenue account would reflect as zero.
Yes, thank
you.
Okay.
Okay. Any other questions? Okay, so course chapter review, we talked about the accounting cycle, right? And all the steps that you are required to know. Yes, this is an accounting cycle. You can't do one without the other. So you make sure you memorize the order that this accounting cycle goes into because we will be taking a look at all 10 steps of the accounting cycle when we complete our fictitious business, right? Like I've mentioned before, the first 10 weeks of class, I'm only going to be practicing from steps 1 through 3. Okay, I'll be providing you the source document. So obviously step 1 is given. Step 2 is whether you're going to take that transaction and you're going to analyze it, sort it in a way that you're going to organize it, and completely journalize it. Okay? So in this case, only steps 1 through 3 are going to be taught in the first 10 weeks of class. All the rest of the steps are going to be done in the last 5 weeks of class. Okay? Make sure you know the exact order. And then, of course, we talked about the accounting period, right, which can be broken into daily, monthly, weekly, whichever way it makes best for your business to complete the accounting cycle, right? That's the definition of what an accounting period is, right? At least knowing the basics of calendar and fiscal year, right, which makes it easier for you to file taxes every year. The characteristics of financial statements, okay? And once again, we took a look at the generally accepted accounting principles, right? You got 4 assumptions, 4 basic principles, and your 4 constraints. And once again, I'm only going to test you on the first 8, knowing the definition, knowing how to apply it to a scenario. The last 4 is I'm not going to test you on it, but I am going to test you to at least acknowledge them, know what they are, as in basic, just knowing what it is in regards to just the title. I don't need to know what the meaning of it is, because in this case, you're not going to be looking into managerial cost accounting. Okay. So again, a best way that I was able to do a little mnemonic devices when you learn your United States GAAP, your generally accepted accounting principles. Think of it as learning your ABCs, right? You got your assumptions, your basic principles, and your constraints, okay? Your A, B, and C, okay? So that's the mnemonic device for you. Just make sure you only know your A and your B's, but your C's are something you're going to learn if you end up pursuing more in accounting, okay? So again, I'm only going to test you on the first 8, right? And then last but not least, we talked about the difference between cash and an accrual type basis. So let's go ahead and dive right into the chapter 4 exercises. Okay? All right. Number 1, what is the accounting cycle?
It is a methodological set of rules to ensure accuracy and conformity of financial statements.
Good. I'm just going to go ahead and type in here method and rules of accounting to ensure accuracy.
Is it safe to just think about it as recording and processing?
That is the definition of accounting. In this case, it's like an actual step to ensure accuracy of accountings and to ultimately create financial statements. So in this case, right, is accounting anywhere in regards to ensuring the accuracy of your accounting and ensuring that you produce the financial statements? No. In accounting, it's where the procedures, the process of recording, sorting, analyzing, summarizing, that's accounting. Okay. Mm-hmm. I put accuracy, okay, and producing Sorry, I'm having technical difficulties trying to type here. There you go, statements, okay? All right, number 2, okay. What are the 4 characteristics of financial statements?
Reliable.
Reliable, yep. You have to have the source documents to back up that you have a transaction. What else?
Relevant.
Relevant, good, meaning you need to be in the same time frame. Next.
Consistent.
Consistent, meaning choosing one type of method and being consistently using that method throughout the entire accounting period. And last but not least,
Comparable.
Comparable. You need to be able to produce financial statements that are comparable for both internal and external users and being comparable to someone else who's either in the same industry. Okay. All right. Number 3, what are the 10 steps of the accounting cycle?
Collect source documents.
Okay. What else?
Analyze and sort data.
Okay. What else?
Record.
Record where?
Record transaction.
Where?
General journal.
In the general journal, okay? Because you have to record the transaction in the general journal, but you also have to record it where on step 4?
Ledger.
You have to post it to the general ledger, okay? And then,
Prepare trial plans.
yes, you must do a trial balance, okay? What else?
Enter adjustment entries.
You need to do the adjustments, okay? And then,
And then prepare adjusted trial balance.
yes, you need to also do another adjusted trial balance, okay? And then what?
Create financial statement.
Good, financial statements, okay? And then what else?
Close.
You're gonna close the books by closing out your revenues and your expenses out to equity. What else?
Trial plans.
Yep.
Post-trial plan.
You need to do the post-closing trial balance. Post-close trial balance. Good. Okay. Number 4. Okay, what is the difference between the calendar year and a fiscal year? You can give
Calendar year.
examples if it makes sense to you.
Calendar year is January 1st to December 31st.
Good.
Or a fiscal year is any 12 consecutive months from the 1st to 31st.
Good. So any 12 consecutive months starting first of first month to last day of 12th month. Okay, good. Number 5, okay, what are the examples of an accounting period?
Daily.
Daily, right? You could do it every day. You could close your books every day. What else?
Weekly.
You could do it every week.
Monthly.
You could do it every month. Yes, you can.
Annually.
And you could do it at the end of every year. Correct.
Why isn't quarterly one of them?
This is just, I only listed 4. So the list can go on and on and on. So quarterly can be one of them. It's just, I'm asking you to just give me 4 examples.
Okay.
Yeah. Okay, number 6, what does GAAP stand for?
Generally accepted accounting guidelines.
Good. Generally accepted accounting principles. Okay. All right, number 7. Okay, what are the 4 assumptions under GAAP?
Business entity.
Business or economic entity. Good. So that one tells us, right, that you need to keep your personal separate from your business. What's next? Going concern, right? Meaning that if you have a foreseen foreclosure, you're still going to continue doing business as usual, right? You're still going to keep going, all right? Number 3,
Measure monetary.
monetary measurement. So whether you have a solid, stable currency, you have a currency that you use, right? In our case, it's the United States dollar, and monetary measurement, right? When you journalize, you do it in terms of measuring value, not quantity. Okay. What else?
Period. Accounting period.
Good. Accounting period. So that means the gap allows businesses to break up their accounting. I'm sorry. What is it? The fiscal year and calendar year based on by breaking it up into smaller portions to be able to, do your profits, to measure profitability. Okay, so whether they're the one that allows you to break up your the into accounting periods, right?
Teacher,
Yes.
I have a question in this accounting period.
Okay.
Accounting period, you mean daily, weekly, annually, monthly? You mean this?
Yes, correct. When that's what GAAP allows any business to do, is they allow them to break up the accounting the calendar and fiscal year into accounting periods, whether it could be weekly, it could be monthly, right? To kind of find some kind of way to measure profitability.
Thank you.
All right, number 8. Hold on, let me pull up and make some room here. So number 8, what are the 4 accounting principles? Or sorry, 4 basic principles.
Historical cost.
Historical cost, meaning you must record the purchase of an asset or at historical cost value or fair market value. The day that you buy it is the amount that you record it right then and there. Okay. Number 2.
Realization revenue recognition.
So in this case, either or, whichever way you want to address it, whether it's realization or revenue recognition. I believe in corporate terms, it's widely used as revenue recognition. Okay. In case this one, you only record revenues when it has been earned. So again, this one goes in hand with the accrual type basis. Okay. And then what is next? Matching principle, right? This means that every revenue that you earn, you must match it to the exact expenses or whatever it is to make up that revenue, right? If it costs you this much money to obtain the inventory, you also have to also match it against its the amount of profit that you put on there. So then it's considered earned revenue. So again, that's what matching principle does. It matches all expenses that are tied together for earning that revenue. Okay. And then last but not least, what is this one?
Adequate disclosure.
Yes. Right? When you have pertinent information about a particular transaction, such as number of employees and what they actually do, okay, you need to justify why you're paying your employees money, right? So you need to have a place to put all that information down, and that's going to be the place is going to be the notes to the financial statement. So then when you say I have a total of $25,000 worth of salaries and wages expense, what does that mean? I don't know where these $25,000 are going. If you're paying somebody for $25,000 for salaries and wages expense, what's the breakdown on that? And that's where you need to place that into the notes to the financial statements. Okay. All right. Number 9. What are the 4 constraints?
I have a question.
Yes.
And the last adequate disclosure. And need the adequate, you mean accurate or exactly, or please explain this.
Okay, so adequate means enough, right? Where you have enough information.
Okay.
okay? Not exact information, okay? So adequate, yes, you're trying to make sure that you have enough information to basically give reason why a transaction has happened, not exact information, okay? So enough information. So again, if I say I have salaries and wages expense for $25,000, my extra information to explain that transaction says that I have 5 employees. I pay them salary based or wage based, right? That's my reasoning for that transaction. Okay?
Thank you.
All right, number 9. What are the 4 constraints and conventions? They don't need to be in a particular order. I'm just asking for any of the 4.
Material.
Materiality. Yes, materiality. Very good. This means, is it significant enough for you to record in your books? So again, I gave you that example, a $5 trash can versus a $10,000 machine. Which one would you record under fixed asset? Okay. Number 2,
Cost benefit.
Conservatism.
cost benefit, right? When you have to weigh out your options for alternative, selections, whether you want to choose this over this, how much is going to cost me, what's the benefit of it, and what are the alternative options. Okay, good. And then next one,
Conservatism.
conservatism. So again, this conservatism, okay, this one is going to be based off of the alternative options that you have for the cost benefit, which one's going to least likely to overstate your assets. So again, you want to be kind to yourself and not overstate your assets, okay? Number 4.
Industry practice.
Industry practice. Yes, so if there are customary practices that another person who's in the same industry is doing, you should might as well follow the same rules and guidelines as them. So again, you can compare your financial statements accordingly. Okay. All right, number 10. Under the cash basis of accounting, revenues are recorded when blank and when blank is received, and expenses are recorded when blank is available to spend.
Cash.
Cash, right? That's what a cash does. Cash, cash, cash. Cash needs to be received in order to recognize revenues, and cash needs to be available for you to spend to make those expenses. Number 11, okay, under the accrual basis of accounting, revenues are recognized when earned. Yes, right? The day that you either sell the product or provide a service is going to be the day that you earn your revenue. All right? And expenses are recorded when blank. Incurred. The day that you either complete the task and it has happened. Incurred. Okay? Number 12, okay? Under GAAP, okay, which rule states that if you that you must separate your personal versus your business? Which rule is that one?
Business entity.
Yes, business or economic entity. All right. Number 13, under GAAP, okay, which rule states that assets must be recorded at original price or fair market value?
The one that
What was that?
Monetary.
Okay, so monetary, okay, is a good guess. But in this case, right, the situation is what rule basically says that when you purchase stuff, you have to put it at its original value. In this case, fair market value, or how much that you paid for it. Now, this isn't in terms of measuring or establishing some kind of unit.
Historical cost.
This is historical cost, yes. Right? Okay, so if that was the monetary, I would say which rule states that when you buy a asset, you must record it at the price that you paid for, or $50,000. You must record it as $50,000. That would be monetary assumption. Okay. So in this case, this one is talking about the rules in what you have to put into your books. Okay. Number 14, under GAAP, which rule states that when, okay, recording a transaction, it must be in terms of value, dollar amounts, okay? Cannot be recorded as quantity or per item. So that would be an example of monetary, right? Where I'm telling you, you cannot record it based on quantity. You have to record it based on the total value in terms of dollars, right? This is monetary measurement to be exact, but I'm not going to test you on the different ones as long as you're able to associate this one is monetary. Okay. Number 15, under GAAP, okay, which rule states that when you have extra information that is pertaining a transaction, okay, i.e. number of employees, wages and salaries, okay, cost of inventory, okay, you must record it in the notes to the financial statement.
Adequate disclosure.
Adequate disclosure, yes. Okay, in this class, we will not be looking at the notes to the financial statements, just because, again, this is very basic level. We're not in the profession to create the actual annual financial report where you have to do a cover of the business, the background of the business, information about who runs the business. That's an actual financial report where you're giving a whole entire summary about the business, what's the goal of the business, and et cetera, right? So if you've ever seen one before, you can go to any corporation and be able to download the actual financial report, and it gives you a guideline of what they did that year, what happened that year, and et cetera, what events happened, and then they have a whole section for the notes to the financial statements. In this case, we're not that level advanced yet, okay? We're only looking at the very beginning of just creating the bare minimum, which is just understanding how to create the financial reports in the first place. Okay? Last but not least, under GAAP, okay, which rule states that all revenues must be equal to all expenses?
Matching.
This is 100% matching principle, okay? All right, so once again, good job, everybody. So, yay, I guess we end class early today. So again, no homework for this weekend, okay? And there's no